I have already told you a little bit about our Psaros Center Distinguished Fellow, Lael Brainard. And our next conversation is going to be between Lael and Nick Timmeros. Nick is the Chief Economics Correspondent for the Wall Street Journal. Again, Lael was Vice Chair of the Federal Reserve Board. She's a former Director of the National Economic Council. She has played such an amazing role in everything that has to do with our financial markets, financial crisis, and we're just absolutely thrilled to have her as part of the Psaros Center, and she's helping us in many different ways. So we're delighted to, please join me in welcoming Lael and Nick.
Well, good afternoon. Thank you to the Psaros Center for hosting this. And as a Hoya, it's always good to be back at Georgetown. Lael, thank you for participating today. I guess to start off, I'll go to the economy. And my question is inflation, the inflation that we've seen this year, going to be transitory? But in other words, what is it that is going to nourish a one-time increase in goods prices from tariffs into a more persistent inflation if income growth is decelerating, if the economy is not imminently overheating?
Yeah, so look, I think that what we are seeing right now is the tariffs working their way into the price system, and it's taking place over a period of time. Back in 2018, 2019, it took 6 to 9 months. So we're still just early in that process, particularly since tariffs really only got settled in many cases in the last month or 2 months. We can't tell yet how much of that is going to show up in the price level. Margins in a lot of industries are higher than they were the last time we saw tariffs. And so there's the ability for companies to absorb some of this by compressing their margins first. And we've seen some of that. And the other thing is there was so much advance notice that we saw a massive surge in imports in the first quarter and inventory building. And only now are we seeing companies go through those inventories. So it'll be a little while before we think that the tariffs have really worked their way through the system and that consumers are completely facing these new prices. And the question that you're asking really goes to inflation expectations. If consumers believe that the Fed has this under control and that inflation is going to go back to 2% within a year or so, then they're going to act like that, and it will help to bring inflation back down after that initial price surge. But of course, we just went through a period where inflation was exceptionally high. And we've seen in consumer surveys that they actually think inflation is likely to be higher. And so what we know from the 70s is when consumers did not have a good anchor for their inflation expectations, inflation just continued to be very high, and it took a massive recession to bring it back down. The other thing that, of course, people are asking questions about is whether the Fed will have the same inflation fighting credibility in this political environment. So I think those are the two risks. But for the most part, it's a really good bet that prices will go up, but inflation will not continue to rise.
So the argument I hear from people who are less concerned about inflation right now goes like this. It says, if I go to I'm getting hit with higher prices, and so I go to my employer and I try to bargain for higher wages. And 3 years ago, we were in a hot labor market. Every business coming out of the pandemic was scrambling to get their workers back, and they were willing to pay up a little bit more for labor. Now they're going to say, good luck, Nick, take a hike. We're not going to give you that wage increase, and there won't be a mechanism there. How do you encounter that argument?
Yeah, so that is very much the kind of traditional view about wages following prices and leading to a wage price spiral. But again, that's only one of the ways that this works its way through the system. If there's a general loss of faith in that 2% inflation anchor, either because the Fed itself is viewed differently or because consumers have just come to expect prices to continue rising, that does give companies more leeway to pass along higher prices. And so I think the jury will be out for the next few months. I am more on the side of believing that it'll be a price increase that will not lead to ongoing higher inflation, but there are mechanisms that it could lead to ongoing higher inflation.
So if you were in your old job at the Fed, I mean, I would think you would have some PTSD about saying, well, it's going to be a few more months. Because you don't, I mean, a year from now, it'll be obvious. It'll seem more obvious than it does today. So the Fed cut interest rates last week, and they seem to signal this wouldn't just be one cut, but you'd probably get a couple more. How comfortable would you have been with doing that?
So I think the right way for the Federal Reserve to proceed is to be humble about what they know and don't know about prices and how much tariffs are going to lead to inflation increases as opposed to a one-time inflation increase that then comes back down. And I think we have heard that certainly from the chair. The chair has talked about risk management, that the reason that they cut rates and the reason they anticipate doing a few more cuts is because they're worried that the labor market might be slowing rapidly. And they want to be able to react to that, but they're keeping their eye on the potential that inflation could be more persistent. And again, because we just had this experience where the pandemic supply shock was seen initially as transitory, but then demand fed in such a way that inflation went higher and was more persistent, I think we have to be at least cautious that consumers might be more inclined to expect inflation to remain higher for longer. And that's why they're doing, I think, the right thing by taking an approach that manages risks on both sides while cushioning the labor market right now.
So I started off by asking you about inflation. I don't want to ignore the other risk, which is the labor market. We've seen payroll growth slow, but we've also seen growth of the labor force slow this year. There are some measures, minority unemployment rates, youth unemployment rates, that maybe suggest, you could be seeing slack opening up in the labor market. How do you see the outlook for the U.S. labor market right now?
Yeah, so this morning we got data which said that the second quarter was really strong, and that consumers were quite strong, stronger than we had seen previously in the data. Meanwhile, as you said, the labor market has softened a lot. The amount of job creation every month has come down to about 29,000 over the last 3 months. It's a huge deceleration from where we were this time last year. And so it is puzzling. Why is the economy growing at a very healthy clip in the second quarter, but not creating jobs? And also in the labor market, a lot of people expect that if you're seeing that kind of slowing, we should see a lot more people becoming unemployed. And yet we saw this morning not a lot of additional people are actually going and getting initial claims for unemployment insurance. So it seems to be a growth picture which is very low jobs kind of growth, and low hiring, but also low firing. So perhaps businesses have been holding off because of uncertainty about tariffs and immigration, tax policy. All those things have been resolved. I think some people are hoping that with that in the rearview mirror, that businesses will be comfortable hiring again. But it is also the case that the kind of businesses that are doing the large amounts of investment, these are not labor-intensive businesses. When you're constructing data centers or you're running data centers, these are not labor-rich kinds of employment situations. And so I think there's a real question whether perhaps the economy is going to re-accelerate in a way that brings lots of people into jobs, or whether we continue to see this very low jobs kind of growth.
Is there a disconnect between the bond market and the stock market right now? Because you have the bond market that's been a little bit more nervous about growth, or at least anticipating rate cuts. You have an equity market that up until the last few days was just going, up 1% a day, new record, new record, new record. So I don't mean to ask a leading question that there is a disconnect, but what do you think explains what we're seeing there right now?
So I think there is this kind of K-shaped growth or bifurcated economy. The equity market, the public equity market, is very much being driven by AI and a lot of anticipation of investments in highly productive data centers, AI, potentially the diffusion of AI over time, although that is still early stages, semiconductors. So those are some of the areas that are really driving the excitement, the very high valuations in the equity market. But again, there's other parts of the economy that are not as bright. Again, lots of sectors of the economy just haven't been creating jobs, and also a little bit glum. So we saw consumers being relatively resilient in this last GDP report. We've seen it in the retail sales. But we hear in the consumer sentiment surveys that people are really worried about their job, and they're really worried about high prices, and they're a little bit glum. And if you look at the composition of consumption, it's really that top 10% of consumers that are accounting for about 50% of spending right now. So that's, I think, why you're seeing some of these discrepancies.
Let me ask about trade policy. What would be your expectation for these tariffs staying beyond the Trump administration? Is this a way of raising revenue that might be a new normal, where the next party will face more pressure to keep a higher tariff rate in place than they might have independently chosen on their own?
So I think it is really difficult to think about what is going to happen if there were a different administration in 4 years with a different predisposition on international kind of institutions and also the contribution of imports to parts of the economy. At that juncture, it'll really depend a lot on how much revenue is coming in through the tariff channel. Right now, it could be $300 to $400 billion a year. That matters in an environment where we are adding another $4 trillion to the national debt. Those revenues are hard to come by and really important, and it's very difficult to raise taxes. And so in that kind of an environment, even an administration that is very inclined to see a more competitive economy where imports are playing a bigger role in some sectors may find it difficult to entirely change the structure of tariffs unless they can identify some revenue replacement. The other potential scenario, and we've seen this in other countries, is that over time businesses actually get pretty good at working around tariffs, and high tariff revenues in the first 2 or 3 years may actually drop pretty quickly after that as businesses change their supply chains, change what they do here in America, and consumption patterns change.
During the week of the Liberation Day announcements, which created a lot of volatility in financial markets, there were some murmurings about whether the Fed would need to intervene to support the Treasury market or other markets. What do you think it would take for the Fed to do something like that?
So at certain moments, if market participants, investors, are really heavily positioned for one set of expected outcomes and they get surprised, you can have these moments where everybody's trying to shift their positions quickly and there just isn't a lot of intermediation capacity. A lot of intermediation right now, particularly in the Treasury market, as we know, goes through principal trading firms rather than that traditional dealer balance sheet. Dealers themselves are not in a position from a risk management point of view to do a lot of risk taking at moments like that. And so what we have found at these moments is that the Treasury market has liquidity, lots of liquidity during normal times, but some of those actors, the PTFs in particular, pull back and do not provide liquidity at moments where lots of people are trying to make trades at the same time in the same direction. So depending on how extreme the kind of market reaction you see, the Federal Reserve has come in at a few junctures to help the market intermediate at those moments. But I think it would have to be protracted, not just a one-day event, because we've weathered many of those without any lasting damage. It would have to be a more protracted repositioning that really really tests liquidity.
Well, and I would add the volatility ended when the administration and the president pulled back somewhat a few days later. So I wonder if there's also sort of a principal agent part of that, relationship.
It's certainly the case that you want the markets to be providing signals in response to policy announcements, and so you would not wish the Federal Reserve to intervene at a moment where it might short circuit that kind of feedback that's important for policy to get.
One of the issues that got some attention, including when you were at the NEC in the last 2 years, was Treasury debt management. Some officials in the Trump administration who were in the private sector then had sort of alleged that the Biden administration was trying to ease financial conditions in a way that was at odds with what the Fed was trying to achieve in their inflation fight, including, for example, by maintaining a higher bill issuance, share of bill issuance. So I'll ask you, was this something that was intended by the administration to affect financial conditions, to more actively manage conditions in the Treasury market?
Yeah, so the Biden administration, the previous administration, was very institutionalist. It was a traditional administration, and in a traditional institutionalist kind of an administration, the Treasury Department really does debt management. It does it with loads of input from the private sector, from an advisory committee called TBAC, and it makes decisions about debt management that are intended to most efficiently steward taxpayer resources, but also to respond to moments like debt limit standoffs, where you build up cash and then you pay out the cash while Congress is negotiating with the White House. And so those dynamics, I think, were the dominant dynamics that affected the Biden administration's Treasury's debt management policies. It was really something that was done by the experts at Treasury. I think what people worry about right now is that because this administration has been so vocal about wanting interest rates to come down in order to lower interest payments on the debt, that's very unusual to have a president say, if you lower interest rates by 1 percentage point, the administration has to pay $300 billion less a year in interest payments on the national debt. Those kinds of statements raise concerns among institutionalists about fiscal dominance. And in a fiscal dominant situation, the Federal Reserve has to work with the Treasury Department to set interest rates in a way that is focused on keeping the cost of managing the national debt low. And in periods where that has happened, inflation can be kind of the losing side of the Fed's responsibilities, and then you get embedded higher inflation over a longer period of time. And so I think that's where there's a concern about a potential change in the institutional relationship, potentially between the Federal Reserve and Treasury.
You may have answered my next question, which was whether the Fed and the Treasury should coordinate more closely on debt management. Are there places in which where that could be done in a less alarming or anxiety-inducing fashion?
So it's very, very difficult to have a central bank subordinate to a fiscal authority in terms of managing interest payments on the national debt. That is the reason in the years following the Second World War that the Federal Reserve fought really hard to be able to separate itself from the Treasury. During the Second World War, it made a lot of sense. We were in a wartime footing, and wartime footings, you do loads of institutionally unusual things, and you have the freedom to do that as long as your institutional setup is really normal in peacetime. But in the years following that, because of the financing of the Korean War, inflation became very, very high. Inflation expectations were not well anchored. And so there was a long kind of fight between the Fed and the administration at the time which resulted in the Fed Treasury Accord in 1951, which really separated them. And I think those are the crisis or a war when it is necessary for the Federal Reserve and the Treasury to work closely, arm in arm, so they're not working at cross purposes. But again, I think the stronger your kind of institutional norms are during normal times, the more ability you have to do that without sacrificing anything in terms of long-term inflation and those moments of crisis.
So you did a nice job of bringing it to Fed independence, which is the elephant in the room right now, and something I want to ask you about. So I don't know, for people who have been following closely, but the president has been very vocal and very unhappy over the Fed not cutting interest rates more. He now has one of his economic advisors was confirmed onto the Fed board last week in sort of an unusual arrangement that will allow him to go back to the White House next spring when his term at the Fed is up. The president is trying to remove a Fed governor right now, Lisa Cook. So do you see evidence that these sorts of political attacks might be seeping in to how the Fed does its risk management? That is to say, the Fed isn't doing something because the president wants him to do it, but there's now a new risk, which is that if we have a recession, the Fed is going to be blamed for it, and we shouldn't risk a recession that would bring with it perhaps the end of an independent central bank over core inflation that's running, say, 90 basis points above our target after having declined from a much higher level.
So look, what I would say is, first of all, why do we care about Fed independence? We care about Fed independence because we have seen central banks all around the world and over history, those that are subordinated to the government, to the elected officials, lose credibility in fighting inflation. And it is a multi-year loss. So once the Federal Reserve loses credibility, it takes a lot more pain in the labor market to bring inflation down and to anchor inflation expectations. That's what we saw with Nixon and Arthur Burns in the 1970s. It really took Arthur Burns and sky-high long-term interest rates and sky-high unemployment. The numbers are really quite startling. And so that's a world that we don't want to go back into. That's a world, Turkey is a more egregious example of that. So what guarantees the independence of the Federal Reserve? Well, it's partly statutory, the Federal Reserve Act, but it's partly convention. And traditionally, it's been fine for presidents to yell at the Federal Reserve, to say they disagree with the Federal Reserve, but there are some things that have taken place recently that are just very different than that. And you mentioned a few of them. First, the president summarily fired one of the board governors. Now, this is completely unprecedented. This has never happened before. In the statute, it says this can only happen for cause, which is to insulate the policy decisions, the policy rationale of any governor. But of course, just announcing a firing without going through any due processing is more like at will than for cause. And now, of course, both the district court and the appeals court said there is insufficient due process, and so stayed it, but now it's going to the Supreme Court. What the Supreme Court decides is of monumental importance here, and genuinely, I think they could go either way on this, so that's important. The second thing that's very unusual is we now have a Fed governor who is serving, who is on leave of absence from a senior position at the White House. That is also completely unprecedented. We've never seen that. We've seen people go back and forth. It is normal for the head of the CEA to be appointed to a position at the Federal Reserve. We saw that with Ben Bernanke. But this is extremely unusual. And of course, the concern is that if somebody wants to go back to the White House, do they change their views in order to make sure they can go back to the White House? Those are the kinds of questions that were asked during confirmation. I don't know how much of this is really in the markets right now, but to come back to your original question, if the markets started being concerned that the Federal Reserve was following decisions that were really to be aligned with the White House, with the president, who of course has an electoral calendar, all presidents do, it could erode confidence that they will be able to control inflation. And when that happens, long-term rates actually go up, they don't go down, because investors need to be compensated if you're holding a long-term treasury for all of that inflation. And so you get the reverse of what the president's really looking for, which is to bring long rates down.
So, as you noted, a lot of Fed independence is not in the law, it's in convention. There are these 14-year terms with the for-cause protection, which is now being really challenged before the Supreme Court. It hasn't been proven that Lisa Cook misrepresented anything. She hasn't said what happened, so it's vague. But I bring this up as to say the three guardrails that I see that enforce these norms are the markets, the U.S. Senate, and the courts. So the courts have acted, and they'll continue to rule here. Are you surprised, though, that at least for the markets or the Congress, that there hasn't been much of a response so far, given what you said, that this is a momentous occasion here?
Yeah, so I think you're exactly right. Three guardrails, and we simply haven't seen pushback either from the markets or from the majority in Congress. Now, normally, the Senate Oversight Committee and the House Oversight Committee are extremely jealous of their oversight of the Federal Reserve. They really think of the Federal Reserve as delegated authority from Congress, constitutional authority delegated to an independent body. They don't think of it as being an executive branch independent agency. They think of it quite differently, and that's how the Fed operates. The Fed is extremely responsive to oversight by their two bodies. But interestingly, during the confirmation hearings, the majority on the Senate Banking Committee really did not suggest any concern about the current developments at the Federal Reserve. And of course, although we saw that sharp market reaction early during April, when you saw a big pushback when the president talked about firing the chair, this time around, when he actually did fire a board member for the first time and did appoint a governor who's on the employment roles of the White House, really nothing out of markets. So the only place we've seen pushback is at the courts. And of course, everything now will hinge on what the Supreme Court decides and what their reasoning is.
So what message would it send to you as if you were still a Fed governor, if someone like Lisa Cook wasn't allowed to, come and do her job because of the allegations that have been made against her?
So I think the thing that I would be concerned about in terms of the long-term institutional independence of the Federal Reserve is if I could be fired on the basis of a tweet without any due process, with very unclear what the cause is, that everybody on the board would be looking over their shoulder wondering what would cause them to potentially be at risk. And I think that would chill, at minimum, would chill the kind of open sharing of views that the markets and the public depend on. Every member of the board and the FOMC goes out in public regularly to explain how they see the economy and how that translates. In fact, we saw that here this morning with Vice Chair Bowman. But if you're worried that you're going to get fired, you might be a little less inclined to do that. So that would concern markets, I would think. The other thing is that according to the statute, in years ending in 1 and 6, all of the 12 Reserve Bank presidents get reappointed. That will be in February in 2026, so soon. And the board gets to approve those reappointments. And so it is possible that you might also see a change in the way presidents are reappointed. And that would go to the broader FOMC because, of course, you need a majority across the board and the Reserve Bank presidents, the ones who are voting for each monetary policy decision.
So that's another form of the Fed's independence, is that there are these 12 Reserve Bank presidents, the Boston Fed, New York Fed, San Francisco Fed. They are not appointed by the President of the United States. They are picked by the boards of their district banks, subject to the approval of the Fed board here in Washington. You oversaw this process in 2021. Has there ever, when you're reappointing these bank presidents who can serve, most of them can serve for 10 years. If you're younger, you can serve for longer. Has there ever been any question as to reappointing somebody for these jobs because of their policy views as opposed to their management. And I'll add that in 2021, all 12 Reserve Bank presidents were reappointed for a 5-year term.
Yeah. So there is absolutely a tradition that I think, in my knowledge, has never been breached, that the reappointment process is on the basis of management and ethical standards entirely. And there is no discussion of policy views at all. And in fact, as you said, I oversaw that process in 2021. We had a very well-developed performance review rubric that we gave to the boards of each of the reserve banks. They're public. You can see what we asked about. None of the performance metrics were with regard to their policy views, because we would have viewed that as violating their independence.
So I'll move on to a different subject, but one more question on this. What message would it send in this idea of maybe having less Fed independence if, say, the president of the New York Fed, for reasons not owing to his, to his performance in the job, was not reappointed come next spring?
I think that would, of course, I don't expect that, and I certainly, many reasons to believe that should not ever happen. But were it to happen, I think that would also fundamentally compromise the ability of the Federal Reserve to deliver independent voting results on monetary policy.
So I want to save time for questions from the audience. I don't know Rena, how we're doing on time. Before that, the last 5 years, the banking system and the financial system has seen a lot. Much higher interest rates than anybody expected in 2022, 23. How well do you think the financial system handled that adjustment? And are there any glaring vulnerabilities you see that regulators ought to address, have left unfinished, et cetera?
Yeah, so certainly I think the largest banks went into the last few financial tests, if you will, extremely well capitalized, great risk management, great governance, and a lot of visibility and hands-on management of liquidity, and it worked very well. They were sources of strength during that period of the pandemic financial crisis that you wrote about, which really was a massive stress event in the financial sector. And the large banks were able to play a stabilizing role. They were also able to play a stabilizing role in the regional banking crisis of 2023. By then, I had moved to the White House, but we were very engaged in stabilizing the regional banking system. And there, I think what we learned is they were being subject to a pretty large interest rate shock, and they had not managed their exposures in ways that allowed them to be stable, and in particular, liquidity management at one or two of the first dominoes to fall really jeopardized the whole system. And so that is one area where I think the Federal Reserve put out some good proposals, and I think they'll move ahead on liquidity management at the smaller regional banks. But I think on the large banks, and you probably have talked about this with Mickey Bowman, who's now in charge of supervision. There, I think the dials are being turned a little bit the other way to give the largest financial institutions more balance sheet capacity to do things like intermediate the treasury markets and adjust the surcharge for the largest banks. There are a variety of things that are probably going to happen over the next little while there that recalibrate a little bit in the other direction.
We will move now to Q&A, and I want to go to students. If there's Georgetown students who have questions, you all should have first dibs at the microphone, and I think there's two, one in each aisle. We'll start over here. If you could introduce yourself and take it away.
So, thank you very much for talking to us today. My name is Alexis. I'm a sophomore in the business school studying operations, analytics, and finance. So, I'm going to go to something you talked about in the beginning. You talked about how businesses have higher margins now compared to the last time that we had pressures from tariffs. So taking that into account alongside with tighter labor markets, do you worry about the reemergence of the Phillips curve? And if so, how does that impact the current inflation anchor?
Yeah, good question. So I think that what we have seen is the Phillips curve is a much softer relationship than it used to be. I haven't seen it be very operative in the economy more generally, and I certainly haven't seen it affecting the response to the tariffs this time around. I think Nick was alluding to that earlier. Particularly now where a lot of the new investments in the business sector are in less labor-intensive sectors, I don't really see that kind of a dynamic emerging. Now, it is true that we had a large influx in our labor supply from the immigration channel, and that has been severed. And so in some areas, like residential construction or agriculture, hospitality, you actually might see shortages there, but those are not traditionally areas where workers are able to have much bargaining power. So I don't expect that to emerge.
Over here.
Hi, I'm Yanita, a graduate student here at MSB studying environmental sustainability and management. And my question is, for the past few months, foreign central banks have been diversifying away from American treasuries, citing both geopolitical risk and questions around Fed independence. What is the Fed doing to reassure global investors that American monetary policy will remain credible and predictable in the years ahead?
Yeah, so good question about dollar dominance. So I think everybody knows the dollar is massively dominant in international financial transactions. So 90% of trade is priced in dollars, pretty much all financial collateral in financial market transactions is dollars. Reserves are held between 55 and 60% in dollars. All of that is because investors have found it convenient to hold the dollar. It is not an official reserve currency any longer. So it's because there are advantages because there's so much liquidity in the treasury markets and because investors have gotten a good deal. The dollar has been pretty strong and inflation on average has stayed pretty low. But I think as people are starting to think again, look at the U.S. with slightly different eyes, if, for instance, the independence of the Federal Reserve were to become less absolutely clear in the minds of investors, they might worry that, in fact, their Treasury securities would lose some value. And you could actually see the dollar eroding. And I think that early stages of slightly less disproportionate investment in dollars, we saw some early signs of that. And of course, the dollar has weakened, but it seems to be stabilizing right now. So it's hard to know what lies ahead. And the Federal Reserve's job is to simply keep inflation low. That is the way that it continues to undergird confidence abroad in the dollar.
All right, we have time for one more question, so we'll go up here.
Hi, thank you so much. I'm Mina, and I'm a sophomore in the SFS studying international economics. Since we were talking about U.S. debt, I'm just curious if it's grown towards a more unsustainable level, and if so, what would you suggest the policymakers do to mitigate this risk?
Yeah, so our fiscal trajectory, I think people have been saying for some time it is unsustainable. That's probably right, but it is always hard to know exactly when you have a moment where markets actually demonstrate some unease about the amount of debt that is being issued. Now, we saw that in the UK in what is now referred to as the Liz Truss moment, when she put forward a very expansive fiscal plan that would have reduced revenues but not spending, and the market really revolted. We haven't seen that in the US. We're unlikely to see that in the US because the dollar has so many advantages and Treasury securities have so many advantages for investors. That said, our debt held by the public as a share of GDP is 100%. We just added another $4 trillion to the national debt in peacetime because of the recent reconciliation package. And so going forward, it will be important to either make up for those revenues in some way or really wrestle the spending side of the equation. But this current fiscal trajectory is not one that anybody should feel comfortable with.
Well, thank you all for joining us this afternoon, and thank you very much, Lael.
Thank you. Thank you.